Why Trump's proposed 401k executive order may be bad news for your retirement. Your retirement savings could be about to become a high-stakes gambling chip in Wall Street's most exclusive casino. While everyone's been distracted by the latest political drama, President Trump is quietly preparing to sign an executive order that could fundamentally transform how your 401k works. And here's the kicker. This change might not be the financial windfall you'd expect. Buried beneath layers of financial jargon and regulatory speak lies a proposal that could open your workplace retirement account to private equity investments. Now, before your eyes glaze over thinking this is just another boring financial regulation, let me tell you why this matters more than you might realize. This isn't just about adding another investment option to your retirement menu. We're potentially walking down the exact same treacherous path that led to the virtual extinction of traditional company pensions, leaving millions of American workers scrambling to secure their golden years. But here's where it gets controversial. Are we about to repeat one of the most devastating mistakes in retirement planning history? Decoding the executive order. What's really on the table? The specifics of Trump's upcoming executive order remain frustratingly vague, wrapped in the kind of bureaucratic mystery that makes your head spin. However, financial experts are pointing to a 2020 opinion letter from the Department of Labor as our crystal ball. This document, originally issued during Trump's first presidency, essentially gave a green light for private equity investments to sneak into your 401k through the back door. The catch? These investments would be bundled into target date funds or other professionally managed investment vehicles, meaning you wouldn't directly choose to invest in private equity, but it would be chosen for you. Think of it like ordering a combo meal at a restaurant, only to discover later that one of the ingredients might be something you never would have ordered on its own. Private Equity Decoded, the investment world's VIP club. Let's strip away the financial industry's fancy terminology and talk about what private equity actually means for regular people like you and me. Imagine there's an exclusive investment club where only the ultra-wealthy get to play. Private equity is exactly that, a members-only financial playground where accredited investors, translation, people with serious money, buy controlling stakes in companies that aren't traded on public stock exchanges. To even qualify for this club, you need to earn at least $200,000 annually, or $300,000 if you're married, for 2 consecutive years, or have a net worth exceeding $1 million excluding your home. The logic? Only people who can afford to lose big should be allowed to play this high-stakes game. And this is the part most people miss. These aren't your typical stock market investments that you can sell whenever you want. Private equity locks up your money for years, sometimes a decade or more. It's like putting your cash in a time-locked vault where the key might not work when you desperately need it. The fee structure that would make a loan shark blush. Here's where things get really interesting. And by interesting, I mean potentially infuriating. Private equity firms have mastered the art of charging fees that would make your bank's overdraft charges look reasonable. We're talking about fee structures so complex and opaque that even financial professionals sometimes struggle to understand them. These firms often charge management fees, performance fees, transaction fees, and monitoring fees, basically finding creative ways to take a cut of your money at every possible turn. But here's the controversial part. Unlike your typical mutual fund, private equity firms aren't always required to fully disclose their conflicts of interest. They might have side deals, preferred arrangements, or other financial incentives that don't necessarily align with making you money. The private equity track record, success stories or cautionary tales? Now, Let's be fair. Private equity isn't inherently evil. At its best, it can breathe new life into struggling companies, streamline operations, and generate impressive returns. Dell's successful 2013 restructuring through private equity is often cited as a textbook example of how this model can work. But here's where the story gets darker, and this is what keeps retirement experts awake at night. Remember Sears? That iconic American retailer that once dominated the landscape? Private equity got its hands on Sears, and the result was a slow-motion financial train wreck that eliminated thousands of jobs and left pension plans in ruins. The same tragic story played out at Toys R Us, where private equity ownership led to bankruptcy and 70,000 lost jobs. These weren't just business casualties. They were real people's livelihoods and retirement security going up in smoke. The $12.2 trillion question. Why target 401k plans? Here's a number that should make you sit up and pay attention. American retirement plans currently hold $12.2 trillion in assets. That's trillion with a T. For private equity firms, this represents the ultimate untapped market, a massive pool of money that's been traditionally off limits because it belongs to regular working Americans, not accredited investors. Proponents argue this change would democratize private equity, giving ordinary workers access to the same high-return investments that have made the wealthy even wealthier. It sounds appealing, doesn't it? Finally, a chance for the little guy to play in the big leagues. But critics are sounding alarm bells, and their concerns are worth taking seriously. Senator Elizabeth Warren has labeled private equity predatory, arguing that these firms often prioritize short-term profits over long-term business health and worker welfare. The fiduciary responsibility minefield. Here's something that might surprise you. Your employer has a legal obligation to make sure your 401k investment options are reasonable and that fees aren't excessive. This responsibility, established under the Employee Retirement Income Security Act, ERISA, has been a crucial protection for workers. When employers fail in this duty, workers can sue, and they've been winning. ERISA lawsuits against excessive 401k fees have reached near record levels recently, which is actually good news because it means the system is working as intended. But here's the controversial twist. The complexity and legal risks associated with offering private equity options might push more employers to simply stop offering 401k plans altogether. Sound familiar? It's exactly what happened with traditional pension plans over the past few decades. Are we repeating history's biggest retirement mistake? 50 years ago, ERISA was created with the best intentions to protect workers' retirement benefits. Ironically, the legal complexities and liabilities it created contributed to employers abandoning traditional pension plans in favor of 401k plans, shifting retirement risks from companies to individual workers. Now we're potentially adding another layer of complexity and risk to an already strained system. At a time when 401k savings rates and balances have reached record highs, and with Social Security's future uncertain, do we really want to introduce a new category of high-risk, illiquid investments into the mix? The uncomfortable truth about average investors. Let's have an honest conversation. The typical American worker saving for retirement through a 401k doesn't need private equity exposure. They need reliable, transparent, low-cost investment options that will steadily grow over time. Private equity's illiquid nature directly conflicts with one of the most important features of 401k. Plans, the ability to access your money during financial emergencies through hardship withdrawals. Imagine desperately needing funds during an economic downturn. only to discover that a portion of your retirement savings is locked away in illiquid private equity investments. The bottom line, convenience or catastrophe. This proposed executive order represents a fundamental philosophical question about retirement security in America. Are we moving toward a system that better serves workers, or one that creates new opportunities for Wall Street to profit from Main Street's retirement savings? The timing is particularly concerning, as traditional pensions have virtually disappeared and Social Security faces long-term funding challenges. 401k plans have become the primary retirement vehicle for millions of Americans. These plans need to be more secure and transparent, not more complex and risky. What this means for you. Even if you have zero interest in private equity investments, you can't simply ignore this development. The indirect effects could reshape the entire landscape of employer-sponsored retirement plans, potentially making them more expensive, more complex, and ultimately less attractive to employers. The question isn't whether private equity belongs in someone's investment portfolio. For sophisticated, wealthy investors, it might make perfect sense. The question is whether it belongs in the retirement accounts of teachers, nurses, factory workers. So here's my controversial take. This executive order might be solving a problem that doesn't exist while creating risks we can't fully anticipate. The average worker's 401k doesn't need private equity. It needs simplicity, transparency, and reasonable costs. What do you think? Are we about to witness a retirement revolution that finally gives ordinary workers access to elite investments? Or are we walking blindfolded toward another retirement security disaster? Should the government be making it easier for private equity to access your retirement savings? Or should these investments remain in the exclusive domain of accredited investors who can afford to lose? I'd love to hear your thoughts, especially if you disagree with my assessment. Are you excited about potential private equity options in your 401k? Or does this development make you nervous about your retirement security? Let's debate this in the comments.